In the year 94 BCE, the Roman Republic's grain markets were roiled by a speculative frenzy that saw fortunes rise and fall on the anticipated arrival of ships from Egypt, long before the harvest was even gathered. The Roman grain market operated on a simple, yet precarious principle: forward contracts. Merchants would purchase future harvests from distant provinces, particularly Egypt, months before the grain was actually available. This allowed them to lock in prices and mitigate risks, in theory, but it also opened the door to a more audacious game. The critical element, however, was that these contracts could be bought and sold again before the physical grain ever reached Rome. This reselling of future harvests created a secondary, speculative market. Traders, without ever intending to handle a single sack of actual grain, would buy contracts for future deliveries, betting on price increases. They anticipated that strong demand or poor harvests elsewhere would drive up the value of their paper claims. Some estimates suggest these paper transactions exchanged hands for sums equivalent to 20,000 denarii, a substantial sum for the period, long before any real value was created. The key to their success lay in timing, buying low and selling higher, all based on rumor and expectation. As the harvest season approached, rumors of potential shortages or bountiful yields would sweep through the forum. A single whisper of drought in Egypt or a delayed fleet could send contract prices soaring by 50% in a matter of days. Astute, or perhaps just lucky, speculators could double their initial investment by offloading their contracts to eager buyers, convinced the prices would climb even higher. It was a self-fulfilling prophecy fueled by collective anticipation, where the perceived scarcity mattered more than the actual supply. This worked perfectly, right up until the point where the actual grain was due to arrive. The height of the mania occurred around the year 94 BCE, when reports, later proven false, circulated that the Egyptian grain fleet faced catastrophic delays due to storms. Merchants, fearing widespread famine, bid up the prices of existing contracts to astronomical levels. Some contracts changed hands for over 200% of their initial value, representing a projected profit of 100 million sesterces for a select few holding the largest positions. The desperation was palpable, with many citizens paying exorbitant sums for promises of grain that did not yet exist. The actual grain, meanwhile, remained safely in port, blissfully unaware of the chaos it was causing. The problem, as with all such schemes, was that eventually, the ships had to either arrive or fail to appear entirely. Then, one clear morning, the ships arrived. Not one or two, but the entire Egyptian fleet, laden with a full harvest. The rumors of delay were unfounded, the storms had passed, and the grain supply was more than adequate. The immediate effect was a devastating market correction. Overnight, the price of grain contracts plummeted by 80% as the projected scarcity evaporated. Those holding contracts purchased at the speculative peak found them nearly worthless, their paper fortunes vanishing faster than a magician's coin. The Roman market witnessed widespread bankruptcies and financial ruin for many who had overleveraged their positions. The fallout extended beyond individual traders, creating significant instability in the broader Roman economy. In the wake of this debacle, the Roman Senate attempted to implement stricter regulations on forward grain contracts, though with limited success. The allure of quick profits proved too strong. The immediate aftermath saw a severe contraction of available credit, and many smaller merchants were forced out of business. The incident served as a stark reminder of the delicate balance between genuine market demand and the intoxicating power of speculative anticipation, especially when disconnected from tangible goods. The grain market eventually stabilized, but the memory of the phantom famine lingered for years.